welcome to KYC, that is Know Your Company. I am Mahima Vachrajani, and the company that we're going to track today is a very interesting one. That is Vaibhav Global. Now, why have we chosen this company? Before I move on to tell you what the company exactly does, to understand as to how the India-EU trade deal will actually benefit the company going forward. In terms of the other aspect, growth is largely led by value for this particular counter. When will actual volume growth pick up for the company? Something that we're going to ask the management and understand whether that is even on the cards. Demand and growth levers going forward, what will augur the growth, because management has given a guidance of medium-term growth in terms of going forward. We'll have to wait and watch out for as to what will be the levers that will be auguring that growth. Now, return ratios for them have slid in the past 3-4 years. So just want to understand in terms of improvement, whether it is on the cards for ROC or ROE not. And medium-term growth targets, what are they looking like going forward in terms of both top line as well as bottom line? So these are the reasons as to why we're talking to the management. Most importantly, of course, India-EU trade deal and how it impacts the company. On the show, of course, we'll also be speaking to Nitin Panwad, who is the Group CFO of Vaibhav Global, who will be joining us shortly. But before that, let's take a look at what the company actually does. Just to understand what about the company looks like. The company is basically an omni-channel retailer which is into fashion, jewelry, as well as this also include accessories, by the way, and lifestyle products in developed markets. Now, if we take a look at the company has been vertically integrated into a digital retailer of fashion, jewelry, as well as lifestyle products. In terms of the overall model, end-to-end B2C business model is what they do, and this is via TV as well as digital channels generally. In terms of the presence through proprietary TV channels and digital channels is what I talked about. In terms of the overall customer base, they have over 7 lakh unique customers transacting. That is the number as per the latest investor presentation as well. And vertically, of course, integrated supply chain is what they have. In terms of sourcing also, they have a strong global sourcing with a base of 30 plus countries where they source from. In terms of where the manufacturing stands, in-house manufacturing in India, so it's a global jewelry hub. Also, has manufacturing units across India and China for them. Also has a factory at Jaipur, which is around that's 1,69,000 plus feet. Jaipur capacity is at that 5 million pieces annually, is what something that the company capacity sits at. But the question really here is that whether that capacity that they're sitting on is fully utilized or not, or what are the utilization levels currently. In terms of brand, these are just some of the names, the brands that the company operates in terms of Home Smart, Evertrue, Caris, as well as something like a Ralph Stray. So, all of these brands, apart from multiple brands that they do, these are some of the ones that you would have come across. In terms of customer visibility, also TV Homes access nearly 127 million households. This is the latest number as per their investor presentation. In terms of where the growing customer base is coming from, the growing digital presence is contributing over 42% of the revenue. In terms of rating parameters, of course, what we'll be looking at today for assessing the company, we generally do 8 parameters. Your income statement will be the first one, following balance sheet, cash flows, return ratios, as well as shareholding, street cred. We'll also look at the valuation and analyst, although not a lot of analysts track this. And we don't have a closest peer of this one, but we'll also see the outlook guidance that the company has given. Now, with regards to the first metric, that is your income statement, let's try to pull that up and see as to how the company has performed, in the last 3-4 odd years. If you take a look at the overall numbers, revenue growth CAGR for 3 years has been at that around 7% mark. EBITDA growth at that 2% mark. But in terms of where the profits stand, profits have slid, right? This, of course, as compared to FY24, FY25 has seen a growth. But as compared to where FY22 stood, from there, profits have slightly come down. So the question really here is that since there has been a growth from FY24 to FY25, will that growth be sustained, and will the company be able to come back to where it was earlier in FY22 in terms of where profitability stands. In terms of where 9 months FY26 revenue stands, overall, in terms of split, right now 58% comes from TV and 42% comes from digital for them. In terms of the geographical split for revenue, 59% comes from US, 30% comes from UK, and 11% comes from Europe. Next, in terms of the overall numbers as to how Q3 has panned out, overall, a good growth this quarter. 9% revenue growth is what we saw at that 1,066 crore. In terms of where EBITDA stands, EBITDA growth stood at that 23.7% mark. Of course, marking revenue largely was led by a value growth and not volume growth. So we'll have to ask that question to the management. Margins also improved for the company. We'll also want to understand as to what has led to that margin improvement at that 12.7%. And net profit saw significant growth of 40.7%. But overall, I mean, if we take a look at how the segments have done, TV business revenue was up 7.7%, and of this, when we take a look at the volumes and value, volumes was down 1.5%, but value overall saw a growth in terms of where TV business stands at that 3.7% mark. That's the average selling price that saw a growth of around 3.7%. Similarly, in the digital business as well, revenue was up 11.2%, from which if you take a look at the volume numbers, volume did see a degrowth. Volume saw a downtick of around 10.3%, but at the same time, the average selling price for this particular segment went up by 17.5%. So I think, overall, if we take a look at both of these segments, value growth has been quite significant in terms of average selling price, but volume growth has not been there. With regards to where balance sheet stands, overall, of course, to conclude for income statement, it's a thumbs down from our end because revenue CAGR and profitability is still, under pressure. But with regards to where balance sheet stands, it's a strong balance sheet in terms of, your equity, your borrowings, your cash as well. So a thumbs up to the balance sheet in terms of where, your reserves are concerned. They've been constantly growing, and the management has, fairly accumulated good reserves. In terms of where debt stands, as of March FY25, they were at zero debt, so nothing of a concern there. In terms of cash in bank, the cash in bank position has slightly come down, but is still at a very good position because they don't have any debt on their balance sheet. So overall, a thumbs up when it comes to balance sheet. Moving on to the cash flow statement. If you take a look at the cash flow statement here, the operating revenues have inched up slightly from FY23 levels to the FY25 levels, but FY24 was a very good year for them when it came to operational cash flow. So we'll have to wait and watch out for as to how FY26 ends. Whether that will end at that around 277 crore mark or not is a question. EBITDA, now, if you take a look at how cash conversion has been as compared to EBITDA, the ratio has been very strong. 56%, 94%, of course, this because the overall operation numbers was, cash from operation number was very high. But even at that 52% mark, the ratio of, operating cash flow to EBITDA is very strong. And overall net cash position has also been reasonably well. But taking a conservative approach, we've given it a neutral rating right now where cash flows are concerned. Moving on to the return ratios, when I was talking about what I want to know about the company and why we've chosen this company, return ratio is one aspect which has been declining for them. And to understand as to what will be the growth levers as to how return ratios will improve going forward is something that we'll know from the management as well. From a 61%, it has come down to that 19% mark as to where ROC is concerned. And ROE has also come down from 32% in FY21 to that 12% mark in FY25. However, slightly improved from that 9% in FY23 to 12% in FY25. So a thumbs down when it comes to return ratios for this particular counter. With regards to where shareholding pattern is concerned, there's skin in the game for the promoters, still holding 57% of the stake. FIs, however, has slightly declined their stake as compared to where it stood in March 23 from a 22% to that 18% mark. DIs, well, have kind of reduced their stake from 6% to 2%, but do not have a large holding. But, you have public shareholding, which has gone up from 15% to almost 23%. And you have names like Vijay Kedia as well as Ashish Kacholia, who have remained invested in this counter, that is Vaibhav Global. Overall, shareholders have remained in that range of 1.3 to 1.35 lakh. In terms of where the street cred is concerned, not been a very good return giving stock if you take a look at the performance, because 1 month down 1%, year to date down 4%, 1 year down 19%. In the past 5 years, it's down almost 55%. So, as somebody who's been a patient investor with this particular counter, has to still wait and watch out for a turnaround to see good returns coming in for the counter. In terms of where valuations stand and in terms of where the overall ratings, analyst ratings are concerned, well, there's no direct peer to this one for Vaibhav Global. But if you take a look at how the analyst, the Arihant Capital, who tracks this counter, has given a buy recommendation with a return potential of 36%. Mind you, it's not done anything in the past 5 years in terms of negative returns of 55%, but Arihant Capital expects a return coming in for 36%. In terms of where valuations stand, well, right now, the current valuation stands at 24 times. The 5-year average PE of this one is 26 times. And going forward, the PE ratio is expected to go down at that 14.8 times in FY28. And if that happens, the stock is going to be available at a cheaper price. So I think valuations is the one place where I've taken a conservative approach and given neutral rating. Lastly, in terms of where outlook stands, outlook overall, remains positive. The company has said that FY26 revenue will be in that 7 to 9% range. In terms of midterm growth, mid-teens revenue growth with steady improvement in margins is what they are expecting. And lastly, in terms of your EBITDA break even for Germany, they're still aimed for FY26. Although first half the Germany business did see a loss. So we'll have to wait and watch out for whether that happens by the end of FY26 or not. So lastly, this is the overall view as to how things have panned out for Vaibhav Global. But let's take a look at the total rating as well in terms of how all 8 parameters have stacked up. Income statement is a thumbs down for us. Balance sheet, strong and very well held balance sheet, thumbs up. Cash flow, a neutral rating and just taken a conservative approach here. Return ratios, definitely a thumbs down because they've been declining since the past 3 or 4 odd years. But for shareholding, it's definitely a thumbs up. You have skin in the game from promoters. You have investors like Vijay Kedia as well as Ashish Kacholia who have remained invested in the counter. Valuations, a neutral approach here and analyst rating combined to this because not a lot of analysts track this counter, and valuations right now as compared to 5-year average still not very cheap, but going forward will get cheaper. Outlook lastly is a thumbs up because overall management is positive with regards to where guidance stands. So the final rating for this company turns out to be 4 out of 8. So that's with regards to where Vaibhav Global. Now let's talk in detail about Vaibhav Global, with the company's group CFO, Nitin Panwad, joining us now. Nitin, thank you so much for taking out the time. My first question with you is with regards to how Q3 has panned out. It's been a good quarter for you. Just want to understand that this growth, from my understanding, is largely a value-led growth and not a volume-led growth. Just want to understand as to when do you expect volumes to come back on the table?
Yeah. Hi, thanks for having me. So past quarter, pretty pleased. We first time crossed 1,000 crore revenue in a quarter, 1,066 crore, 9.1% growth year over year. With a decent margin improvement, around 170 basis points year over year. So pretty pleased with the performance. Volume is because the company plays with the wider product bouquet that the around 30,000 different SKUs. And we follow the strategy, the consumer demand for which product is in correct trend in the market. So product price point moves from $5 to $40, $1,000. So right now, as you have seen, the lab grown demand is pretty high. So lab grown tend to be higher price point. So consumer acceptance is over there. So we are offering continuously lab grown products to them. That is resulting the higher realization from the customer. But they say at the same time, lower revenue growth, lower volume growth, but the realization is pretty high. So overall spend per customer is higher than our previous trend. And we expect that the offering to the customer will continuously play where customer is looking for product like a year back, that customer looking more gold items where they see a safe haven or investment items. right now more on lab grown, and maybe the other categories will thrive in coming time, but it will be a pure drive of a consumer require need, or what consumer is looking for right now. And we anticipate that the overall revenue growth will continue to perform well. Around, we have guided this year 7 to 9, and next year around 9 to 11% we are guiding. We have a strong belief that it will continue to outperform our expectations.
Nitin, just want to understand, since you mentioned lab-grown diamonds, just in terms of where lab-grown diamond prices are concerned, they've been falling. Does this mean that here also you will be focusing on volumes to make that mark in terms of where the top line stands? And how is this shift in terms of gold to lab-grown diamonds, and how does this affect your margins?
Yeah. So lab grown normally is a higher margin category comparatively plain metal and other jewelry. And that's the same we have seen our this quarter gross margin improved say to 63%. And we see that the price is going down, but the product offering, we are continuously injecting new products from studs to bracelet to different sets, but continuously injecting new products to mitigate the customer requirements. Though the pricing falling, but the offering related to carat size and above item is continuously increasing. So demand is there. We have seen past quarter around 30% growth from lab-grown product, and share is increased to around 12.7% of overall business. So that's where we see right now the customer's demand is there, and it will continuously to improve our margins.
Nitin, day before yesterday, India and EU signed a trade deal, which is called the mother of all deals. How does this trade deal have a positive impact to you, if any, of course, I would want to understand. And does this mean, if it does have a positive impact, does this mean that it will bring, more customers to you, or does it mean that cost for manufacturing and then sending these goods to the EU becomes cheaper for you?
So trade deal is always a welcome for all across the world in any country who does a trade deal. It gives more entry, removes all the entry barriers in the market. Right now, if I specifically talk about the jewelry, we operate our Germany business is directly impacted with this trade deal. 4% duties right now, which will be removed. I think the transition will happen in next, I think, across a year, but this will definitely help us to more easiness of trade and the duty reduction. Cannot guide on the margin improvement, how it will be, how much will pass on, how much will stay in our profit and loss account, but it will be definitely improve our company's overall per se in terms of customer demand or competitiveness of our product in Europe.
Okay, understood. Nitin, you said that you crossed that 1,000 crore in the last quarter. Just want to understand going forward, because you're aiming around that 11% mark in the next year in terms of where the top line growth stands. What do you think will be the growth levers? Where do you think the demand will come from for you?
Sure. Yeah, so we have multiple growth levers. One of the important growth levers, we continuously investing on digital fronts, from mobile apps to OTT to smart TVs or our own websites, and the paid media marketing that we are doing. Digital in past 5 years has grown roughly around 17% CAGR year over year. And we anticipate that the initiatives towards the acquisition of customers through digital and having the omnichannel experience from our live streaming to the digital platform or to the paid media to OTT will be there to improve overall customer lifetime value. So that is the one important lever that we are investing, and it will continue to thrive. Apart from that, the different categories that we are launching, the lab grown, expanding our lifestyle categories. Lifestyle share is now 35% of our business. Earlier, which was like 6 years back, it was less than 20%. So that different product categories from beauty to handbag to accessories, that is continuously expanding. That is also another lever to improve. Another thing is that also our Germany business is growing faster than the other territory. It will continue to thrive. And this financial year, we are past quarter we made a full profitability in the Germany business, and expecting that this year will be the slight profitable operation from Germany business, and from next year onwards it will add in our bottom line. So the digital Germany and the OTT expansion will be the key drivers for our growth in future.
Interesting. Nitin, the other aspect, you mentioned that lifestyle products is now almost 35% of your overall revenue, right? How does this mix change from a long-term perspective, let's say 2 years down the line? And then do you think your margins will be able to improve from here on? Do you think the margins in the lifestyle business are better than your jewelry business?
Margins is very close to lifestyle business,
Okay.
to jewelry business in lifestyle categories. And we are our midterm aim to increase the lifestyle business to 50% of total, as the customer acquisition and the repeat purchase and is high on the lifestyle categories. So that will be the midterm target is half of the business size through lifestyle products.
Okay, Nitin, you talked about the growth levers in terms of where the top line is concerned, but just want to understand in terms of your return ratios, right? Your ROA and ROC has been falling, but has improved as compared to where it was in FY23 and FY24. So that's a good sign in terms of where the positive momentum has kind of kicked in. Just want to understand in terms of the levers that will probably improve these return ratios going forward. And what is the range in which you will be looking at for your ROE and ROC to end by the end of FY26, by the end of FY27 as well?
Sure. Yeah. Though we cannot guide the exact number, but our companies aim to increase the ROC to 25 to 30 range. And this just quarter ended on TTM basis. ROC is improved to over 20%, 21% just we closed. And we aim to improve to a 25 to 30% ROC in the business. ROE is also improved to 15% in the current quarter. As our profitability margin is improved, 40% year-over-year growth in PAT we have seen in past quarter. So that is driving to improve our ROE and ROC both. Though the capital efficiencies we are continuously building in our business, our net cash in the business is around $24 million after all the loans and advances. So good amount of net cash we have built up in business, and it will, because of the beautiful business model we have, pretty much all of the profit generates in the cash, and also we distribute to the shareholders through dividend, will result into positive cash in the business and better returns ratio.
Okay. With regards to your manufacturing facilities, what are the capacity utilization that you're sitting at right now?
Yeah, pretty much I think 60 to around 70% utilization that we have, but we get the B2B orders from other European or different vendors we have. So not worry about the capacity utilization, and there's not a capital intensive also this jewelry manufacturing that is not required huge amount of capital. So easy to expand also once you have more orders from different territories. But the good thing is that this quarter onwards, we have started our casting manufacturing facility in America to fight against those high tariff situation. So the casting process is happening in America, and the later process is happening in India, which is helping us to benefit around these high tariff scenario. Though the overall cost is increased around 480 basis points, but still we managed to improve our gross margin by 30 basis points in America.
Interesting. 30 basis points of improvement from the America business. But this was going to be my next question to you, Nitin, that overall, because of this entire US tariff overhang, how has that impacted your business in terms of where demand stands and top line growth as well? And what do you expect going forward now that you have a casting manufacturing facility there? Do you think things to improve from here on? What's the view?
Yeah, definitely. It was the last 1 year is most uncertain time where the multiple amount of tariffs and from 10% to 25 and then 50% increased. So pretty hard to always to fight against the pricing and the what margin that we should charge the customer. But the agility we have and operation around all the Asia locations is navigating and helping us to better management of this tariff scenario. And when the high tariff was implemented in India, then we started sourcing from China, Thailand, or the other country that we have a manufacturing and sourcing facility over there. But over the period of time, we have also started our manufacturing facility around in September time in US, and after that, that is helping us to almost zero tariff on the goods movement from India to US. It's just the value addition part that we are paying tariff, and around 480 basis point, as I mentioned, it was increasing our costing, but pretty helping us in terms of competitiveness, in terms of our pricing of the product, and also the offering is pretty fast through this process right now. So that is, I think, helping us to set up a factory over there. And the consumer demand is pretty, the consumer sentiments right now in US is pretty tough, not an easy, but due to our agility and the better pricing and manufacturing is giving us the more demand from the customer side of our jewelry products, as well as on our digital platforms.
Right.
So we see that optimistic side on the mid-teens number, mid-single
Right.
digit number from US perspective.
Got it. Nitin, thank you so much for being so candid with your answers and, of course, taking out the time and speaking with us at NDTV Profit, and all the best for the future. But viewers, we're completely out of time on this edition of KYC. Stay tuned to NDTV Profit for more news and updates up on the other side.